What's up, everybody? This is Jacob Sandoval from the DeRosa Group. I'm the head of investor relations, and we partner with investors like you to buy large apartment buildings to create passive income and grow your wealth over time. In today's video, we're breaking down Multifamily Syndication 101. What is it? How is it structured? What are some of the key terms to understand? And whether or not it's the right investment vehicle for you. What is multifamily syndication? Multifamily syndication is just a fancy way of saying a group of people are pooling their funds together to buy a large apartment building. Now, multifamily syndication is great because maybe on your own you could buy a 1-unit, a duplex, a triplex, or maybe even a 10-unit apartment building, but very few people have the capital and the capabilities to buy a 100+ unit apartment building like we do here at the DeRosa Group. Now, as an investor, it's very important to understand how these multifamily syndications are structured. And to elaborate further, there are two groups in multifamily syndications: the general partners, also referred to as the GPs, and the limited partners, also referred to as the LPs. The general partners, or GPs, are the active operators in the deal. They find and negotiate the deal, they're managing the property, and eventually brokering a successful exit of the property to generate a return for all the investors. The limited partners, or the LPs, would be you, the investor. Your job as an LP is to find a deal that you like and an operator that you trust. But after you make that investment, you're not expected to do any work. That's on the general partners, and that's what makes this a passive investment for the limited partners. Now, syndications can be structured in a variety of different ways, but a simple syndication structure looks like the general partners, or the GPs, own 30% of the deal, and the limited partners, or the LPs, own 70% of the deal. And that 70-30 ownership split dictates how profits are split amongst the GPs and the LPs, everything from cash flow all the way to profits from the sale. Let's talk returns. Now, we could spend an entire video talking about the returns of a multifamily syndication and all the important metrics, but to keep this brief, we'll talk about the top 3 metrics that you'll see when evaluating multifamily syndications, and that will be the internal rate of return, or the IRR, the equity multiple, and the cash-on-cash return. The internal rate of return, or the IRR, is the main return metric for a multifamily syndication deal. This is the return that we use to compare to other investment opportunities like the stock market or other multifamily syndications. If a multifamily syndicator is saying that the internal rate of return, or IRR, is 15%, and you know that you can get anywhere from 8 to 10% in the stock market, that syndicator is claiming that this will have a much stronger return than the stock market. An important thing to understand about the internal rate of return is it takes into account the time value of money. So the timing of when you receive the cash flows, or the return of capital, or the timing of when they're projecting to sell the multifamily property all impacts the internal rate of return. The equity multiple is a simple metric that shows how much is my money going to multiply by investing in this project. So as a simple example, if I put $100,000 into a multifamily syndication and the equity multiple is 2, that by the end of the project, I should receive $200,000. Now, an important thing to note about the equity multiple is there's no component of time. You can have an equity multiple of 2, but the project was 2 years, versus an equity multiple of 2, but the project was 10 years. And you can imagine those are very different scenarios. And that's why you have to look at the equity multiple in conjunction with the internal rate of return, which does have a time-weighted component to it. The last key metric to understand in a multifamily syndication is the cash-on-cash return. And this metric simply states how much cash am I generating as a proportion of how much cash I invested into the deal. So as a simple example, if I invested $100,000 into a multifamily syndication, and on an annual basis, that investment is generating $8,000 in cash flow, then my cash-on-cash return for that deal would be 8%. This is a very important metric to understand if you are a retiree, or if you're relying on the cash flow from these investments to pay for your living expenses, then the cash-on-cash return is something that you have to evaluate very closely. So now that we've covered the basic premise of what a multifamily syndication is, it's time to decide if it's the right investment vehicle for you. The first thing to keep in mind is whether or not you're an accredited investor. An accredited investor is someone that makes over $200,000 a year from their job, $300,000 if they're married, or has a net worth of more than $1 million excluding their primary residence. A lot of these opportunities are private investments reserved for accredited investors only. These are rules and laws created by the Security and Exchange Commission, or the SEC, to protect investors. Now, if you're non-accredited, there might still be an opportunity to invest if it is a 506B syndication. And that requires that you have an existing relationship with the syndication. So if you are a non-accredited investor, I recommend that you reach out to your syndicator like the DeRosa Group to make sure that you can qualify for the 506B opportunity. The other thing to get comfortable with is the fact that these real estate investments are long-term investments. Typically, you'll have your money invested into the deal for 5 to 10 years, and you have to be comfortable with that time frame as an investor. Because this is a hard asset and real estate is not very liquid, it won't be very easy to get your money out of the deal if you need it sooner than that 5 to 10 year hold time. So you have to be comfortable with that as an investor. But if you are comfortable with that time frame, multifamily syndication is a great way to diversify your investments outside of the stock market and get all the benefits of real estate, cash flow, appreciation, and the tax benefits without any of the hassles of being a landlord. I hope you guys found that video helpful. If you're a passive investor looking for new operators to invest with, we are the DeRosa Group. We have been doing multifamily syndication since 2005. We currently have just under 2,000 doors in our portfolio and $150 million of real estate under management. Our mission is to transform lives through real estate, and we love creating passive income for our investors. Book a call with me in the link in the description and below, and we can take a deep dive into your investment goals and see if passive investing in multifamily syndications is right for you. We'll talk soon.